Welcome to this week's series of Credent Connect. And today we'd like to provide an update on capital markets, the economy, general inflationary trends, interest rates, and most importantly, how we're positioning here for the second half of 2024 as we gauge where the markets may be headed and how we believe things may transpire. And one of the really key kind of critical things to focus on is this disinflationary trend we have witnessed and how the Fed's lagged impact has actually transpired. Alisha, where is that inflation trend today, kind of with the latest data set? And what can we expect from the Fed potentially here through year end to actually further combat that inflationary pressure?
Sure. So when we think back during the pandemic, right, we had inflation at over 9%. What we saw is a steady decline over last year. Things were looking really great in the first quarter. Things started to creep a little bit higher. But now over really April, May, and June, what we've seen is that disinflationary trend continue. So that is a really good sign. We are now in the low threes for CPI, which is fantastic. And the Fed is looking at that to see, one, is it meeting its inflation mandate, which is a target of 2%. They are getting there, which is great. What that will transpire is for easing in monetary policy. So what we're looking at and what the market expects is that first rate cut coming later this year, right now pricing in almost 100% probability in September, and possibly a second rate cut there either in November or December.
Yeah, and the Fed cutting interest rates, it's really important to note that, yes, it's a function of their plan achieving lower inflation overall, as you mentioned with the consumer price index, that basket of goods coming down in that price change. But it could also be a function of a generally slowing economy. And that slower growth is intentional in this case by the Federal Reserve, right? Rather than slamming on the brakes, we're kind of like slowly pushing on the brakes to intentionally bring the economy to lower levels. Employment data has certainly been a factor of that, as we're seeing lower job openings, which were now at pre-pandemic levels, right? For every open job, there's roughly 1.2 available workers, which is exactly how it was pre-pandemic. When we look at that for the second half of the year here, right, and as we're planning as to what may happen across capital markets, we are positioned in a way that doesn't allow for that excessive risk profile to take hold. Alisha, talk a little bit about our equity stance here, especially in the large cap space, right? The biggest companies in the United States, how they're over, the growth oriented or value oriented. Where are we seeing the most value from a potential return standpoint? And how are we positioned here over the next 6 months to take advantage of that?
So within the equity space, we find the most value domestically over internationally. But then on the large cap side, and as a factor weighting, we are looking at growth. The reason behind that is we still have really strong technicals, so that is what has been working year to date. When looking at earnings and some of that fundamental backdrop, the earnings growth there looks very promising. So we are on a slight tilt towards that growth factor.
That growth factor. Yep. And we've been tilted to that growth factor over 9 months now or so. And what's really important to note is valuations are one thing in that space that seems maybe stretched. But it's critical to point valuations, right? How much are we paying for $1 of earnings? Valuations over time are the worst timing indicators possible. So although over a longer term, it doesn't kind of play out well to invest in such valuations, shorter term, it does not impact that expected return profile, things that we're looking at. And of course, on the investments front, from a fixed income standpoint, when we started the year, there's a lot of discussion across investors. Should I just simply go into bonds and capture a 5.5%, maybe 6% annualized yield on my investments? We were adamant against that at the beginning of the year, right? If we look at it, the data today, equity market returns rather, and equity portfolio returns here internally at Credent, we have more than doubled that expected return profile of yields, right? So the opportunity cost has been favorable in this case. And we continue to believe the equity market participation over the next 12 months, when kind of executed appropriately and very methodically with a risk-centric approach, does stand to benefit for investors.